People usually think that futures market is very speculative, but it is not necessarily the case. Futures contract is, in fact, a contract for producers and suppliers to minimize the fluctuations in price, which we call hedging. For instance, beer factories rely on the wheat supplies to fulfill their need in raw materials. Let's say Froggie Beers is a beer producer and Jack is a farmer to supply the wheat. The original price of the wheat is $10, but then drops to $5 due to excessive supply in the market. Froggie Beers benefits in this case as the producing cost drops, but Jack suffers a profit decline. On the other hand, if the supply of wheat drops due to the extreme weather, the price will rise. Jack will benefit, and Froggie Beers will suffer instead. Because of the fluctuations in the markets, many companies suffer from unpredictable changes in profits and losses. In order to minimize this risk, futures contracts are derived in the market. Both parties will construct a contract with investors agreed to buy or sell the underlying asset at a specific price in future transactions. Back to our case, Jack should construct a contract with investors who agree to buy the wheat from Jack for $10. Even the market price of wheat drops to $5, investors still need to buy the wheat at the price of $10 from Jack, which enables Jack to lock up his profit. On the contrary, when the market price of wheat is higher than $10, the investors would be profited from it. How about Froggie Beers? The beer producers can also construct a futures contract to lock up the cost of the wheat at $5 to hedge and reduce the risk of the price fluctuations. As a result, the risk and return in the market have now been transferred from Froggie Beers and Jack to the investors. However, nowadays people do not often trade and settle commodities physically. Instead, the exchanges act as intermediates to facilitate the trades. There are different kinds of futures derivatives in the market as well, such as indices, metals, energies, or even temperature. Today, unfortunately, the purpose of trading futures contracts lie heavily on speculation rather than on hedging.